everybody, and welcome to the Texas Real Estate and Finance Podcast market update for the week of May the 14th. I'm your host, Mike Mills, a local North Texas mortgage banker with Geneva Financial, and I hope all you moms out there had a great Mother's Day weekend. If you're anything like my household, I was trying to coordinate two teenagers to do something nice for their mother. My son, of course, had no money, so he decided at the last minute that he was going to wake up early, which was a big feat for him, and make his mom coffee and breakfast, which she doesn't really eat, but he's trying at least, I guess. It just ultimately meant that I had to get up early too and help him because he's a teenage boy and mostly a moron. And I didn't want him destroying the kitchen or burning down the house or anything. And then I tried to explain to him that the true gift to his mother would actually be cleaning up after himself in the kitchen so she didn't have a mess that she had to clean up or I had to clean up. And I'm guessing all you moms out there would agree with that sentiment. My daughter, however, decided that she was going to go shopping with her friends the day before and used it as an excuse to get out of the house for several hours. And then chose to spend the night away from home that evening as well. And then, of course, like all good married couples, I followed my wife around while she got stuff for our moms. Because that's what you get when you get married, right? I'm responsible for my wife's gifts, which I'm terrible at, by the way, and she handles all the rest. That's a pretty good deal, I'd say, at least for me. But either way, I hope everybody had a great Mother's Day weekend out there. I hope you enjoyed time with your family and got a little break from this crazy thing we call the housing market. And now we are back to the grind. And there is no place that I would rather be than right here with you guys, dissecting this market and finding opportunities. That's what I'm here to help you do. So what do we got on tap for today? Well, of course, we'll dive into interest rates and see what the current state of the economy is along with it. Are we in or headed towards a recession? And what could that mean for rates? I'll give you updated numbers for the national and local Texas housing markets just to see what the summer might hold in store for us. Foreclosures are spiking in Dallas-Fort Worth, but not in the way that you might think. I have an update from last week's episode on the build-to-rent homes in the United States. There's some big players making moves in that market. And at the very end, I'll give you some hard numbers on why renting right now instead of buying might seem cheaper overall, but it's still a losing strategy, especially in the long run. Your clients are going to need to hear these numbers if they're even considering buying anytime in the near future. So as of today, May 13th, according to Mortgage News Daily, the average offered market rate on a 30-year conventional loan is about 7.125%. And the average FHA offered market rate is about 6.625%. Now, these are slightly down from this time last week, and they're trending in the right direction if you're a fan of lower rates. And just for a little context, so you understand the impacts of rates when they change. On a $300,000 loan, an eighth of a point difference from, say, 7.25 to 7.125 is about $25 a month. So if rates drop from where they are now, from 7.125 down to, say, 6.875, where rates were about a month ago, that's a quarter of a point difference. And people will really start getting more excited about buying because their rate starts with a 6 instead of a 7. But that's only $50 a month less on that monthly payment. And you would say, well, Mike, $50 is $50. And you would be correct. But the other thing to factor in here is when headlines say rates are now in the 6s and not in the 7s, then more people will pile into the market to start buying again, especially as we move into the summer. And the other impact that change could have, not will, but could, is that house your client had their eye on listed for $325,000 in this scenario is now going for multiple offers, and that price just jumped up to $335,000. And that $10,000 in higher price just cost your client $65 a month on their payment, and maybe even cash over appraisal if it gets into a bidding war. So lower rates are good, but not for housing prices, at least while we still have tight inventory. Now, what is happening in the economy that is causing rates to start to decline, especially if the Fed hasn't moved anything yet? Well, during the last Fed press conference, Jay Powell put to bed the idea of rates increasing this year and still left the door open to 2 or 3 cuts still. And I personally believe that unemployment is playing a big role in his reason. I think the Fed is starting to see the writing on the wall because remember, the Fed has a dual mandate, stable prices and full employment. So you see, inflation is still higher than the Fed would like before they start cutting rates. But you see, the things that are truly the most impactful to inflation right now are things that the Fed cannot control. Insurance, healthcare, food, gas. These are all the things that monetary policy cannot affect, but right now is the biggest part of inflation. What they can control is the cost to finance a car or a home. And oh, by the way, we've seen the demand for these things dramatically drop, and spending on non-essential goods has dramatically dropped. And these are the things that the Fed can impact. But you see, if unemployment goes up more, I believe the Fed will start to ease rates. But you have to understand that impact is going to be minimal, and it's going to take time for things to change in the economy overall. And just to my point on unemployment, jobless claims came out on Thursday last week. We finally saw a much different number than we'd seen over the past 12 weeks to the higher side. Not by much, but it was a change either way. And it's the highest number that we've seen in almost 9 months. With these numbers finally starting to be a little different, I'm wondering if the BLS finally heard all the questions being answered by everyone out there and started adjusting their equations a little bit. Because 12 weeks in a row of almost the same numbers with 300 million people is a little bit odd. Continuing claims or individuals remaining on unemployment rose by 17,000 last week to nearly 1.785 million. This is near the highest levels that we've seen since 2021. We're also seeing more and more revisions to the job data that was showing job growth. But as the data actually starts to roll in, we're seeing actual job losses, even with the part-time job data skewing it a little bit. In fact, rather than creating 640,000 jobs in the third quarter of last year, we now know that we actually lost 192,000 jobs in the third quarter of 2023, which leads a lot of people to think the recession may have started back in the third quarter of last year. Now, a company called Macro Edge has been really following a lot of this layoff data. They track public layoff announcements. Now, this time of year typically does not have a bunch of layoffs compared to, say, like January, where there are more after a holiday season. But in April, we already outpaced January job losses for this year. There were 115,000 job losses in April compared to 104 back in January, which is a very odd flip of those numbers. So just like we're starting to see home inventories rise at a time when we typically see them going down as we go into the spring buying season, job losses are also mounting up at a time that we don't typically see them. So are we headed into recession? Or maybe already there? Well, it took 15 months to determine that the first quarter of 2008 was actually a negative number. And it took so long because of revisions to data that happened over that period as data came in that was actual numbers versus forecasted with samples and equation. And this is what's happening right now in the job market. So you got to understand that the administration is most likely going to hold off as long as they possibly can on revealing bad data, because doing so would affect the ability to win the election this year, which is why you're seeing so many numbers not making sense and revisions happening much later. Because the market watches these headlines and reacts. Then it slowly changes as the real data trickles in. And oh, by the way, our attention spans are incredibly short these days. So if you keep all the headlines really positive, true or not, you can get the sense the economy is doing fantastic, even when it may not actually be. But either way, the recession is good for rates. So if you're a fan or rooting for lower rates, then economic recession can be a good thing, at least in that respect. So if this trend continues, we might get further relief for interest rates as we move into the summer. All right, let's take a look at the most recent housing data. So rates have fallen recently and inventory growth was higher last week than the previous week, but it was expected to be higher than it actually was. However, it was Mother's Day weekend, so that could have had something to do with a little bit of lag in the data. So on the weekly inventory changes from May 3rd to May 10th, inventory rose from 559,000 to 568,000. This same week last year, inventory rose from 420,000 to 421,000. So a little bit bigger spike. Now, again, the all-time inventory bottom was in 2022 with 240,000 new listings coming on that week. And the most recent inventory peak for listings was in 2023 at 569,000. But again, remember, in 2015, active listings for this time at that period was 1.1 million. So we're still well off from the highs on listings hitting the market. Now, one encouraging development for 2024, at least compared to 2023, is the year-over-year growth in new listings. This is a very positive shift for home affordability, considering 2023 marked the lowest levels ever recorded. Now, the growth rate is slightly lower than anticipated for the year, but it's still a step in a positive direction. So for this week in 2024, we had almost 69,000 new listings hit the market. In 2023, though, it was about 62. And in 2022, it was right around 73. Now, purchase application data was also up week to week, but still down very much from last year. We are seeing better positive sales growth on weekly pending sales data, but this can be partly due to a higher percentage of cash buyers in the sales mix that purchase applications usually don't account for. It just means that investors are still buying and they don't often need to go through traditional mortgage channels that are tracked. Now, here locally in the Dallas-Fort Worth area, there has been a significant uptick in foreclosures, but not residential foreclosures. The Dallas Morning News reported last week that commercial foreclosures were up 129% from this time last year. March of 2024 saw 55 commercial foreclosures, at least according to Adam Data Solutions' latest research. That's compared to just 24 in March of 2023. Now, that March sum was enough for the fourth largest in the country, behind California, New York, and Florida. And the foreclosure auctions for these commercial properties are taking place, and investors are getting some of these for pennies on the dollar. Work from home, high rates, and company layoffs have all contributed to these sales of properties. Residential real estate is still increasing in value every day, but commercial space all around the state, especially here in North Texas, is really starting to feel the pain. Don't be surprised if you start to see local area banks that fund many of these deals start to feel the pinch as well. This is a market that we definitely need to keep our eye on. Now, in the local residential market, in the last 30 days, homes for sale in the Dallas-Fort Worth area sold for a median price of $406,000. Now, this is up almost 2% compared to this same period last year. So prices are still going up. The median price per square foot was about $200. This is up 2.1% from last year. In the last 30 days, there were 8,400 homes sold, which was down from 8,800 last year. So sales are declining, but not too much. However, last year was not exactly a booming year for sales either. Now, yesterday, the total number of homes for sale in the Dallas-Fort Worth area was about 36,000, and that's up 24% compared to last year. So listings are going up, and this is great for affordability if that trend continues. In the last 30 days, almost 11,000 new homes were listed for sale. This is down about 6% from last. And when new listings are down, but overall listings are up, that usually just means that the homes are sitting a little bit longer. And to my point, the median days on market was up to almost 22 days, up from almost 20 days last year. The months of supply was also up to 2.87, up from 1.93 months of inventory last year. So the months of inventory is getting much better than where it was. But remember, we still need 5 to 7 months of supply for a balanced housing market. Now, almost 21% of homes sold above list price, which is down 7% year over year, and a little over 34% of the homes listed dropped in price, which is up almost 2% from last year. And often this is just all about how you price the home. Are you pricing it to sell, or are you pricing it to satisfy the needs of your sellers? Because that ultimately determines if you're going to sell above asking or if you're going to sell below. Because as we all know, if the house isn't selling, it's always the price. Okay, so that's the housing market for this week. Listings are increasing, but volume is still pretty low. But the trend to lower rates might start to swing that as we move into the summer. Only time will tell. All right, I want to give you a quick update on the build to rent story that I did last week in my market update. So my main segment for the market update last week focused on build to rent and how it's affecting the long-term health of the US homeowner. Now, the Cliff Notes version of that was that it's not a good trend, at least if you want to own a home one day or build a path to wealth instead of just renting for the rest of your life. Well, unfortunately, there was more news this week that just worsens that trend. So Invitation Homes, the nation's premier single-family home leasing and management company, announced that they are entering into a joint venture with Katara Group Incorporated, a wholly owned subsidiary of Lennar Corporation, Centerbridge Partners LP, and other high-quality institutional investors. Now, as part of their agreement, Invitation Homes has acquired a minority equity interest in a portfolio of single-family homes for lease that are part of the Upward America joint venture. Now, Upward America has selected Invitation Homes to provide management services to the 4,400 homes located primarily within Florida, Texas, and the Carolinas. Stuart Miller, the executive chairman and co-chief executive officer of Lennar, stated that the shared build-to-rent vision between Lennar and Invitation Homes creates opportunities that make single-family lifestyle and a quality-built home more attainable. Notice he said single-family lifestyle, not single-family home ownership. They're saying that we'll build you a home that you can rent that's not an apartment. Now, Dallas Tanner, the chief executive officer for Invitation Homes, stated that including these homes, the total number that we own and or manage approaches 110,000 homes. Through these new relationships and additional efficiencies of scale, we believe we can achieve meaningful growth for our stockholders and a significant expansion of our premier service and experience for the residents of Upward America. Lily Hayburn, the managing director of Centerbridge, she stated that Invitation Homes' investment in the joint venture validates our thesis around the attractiveness of high-quality new homes concentrated in some of the fastest growing markets in the country. So this is from a press release celebrating this merger, of course. But if you're of the mindset that the best path to the best neighborhoods and the best America possible is for the majority of people to own their homes, well, this is not a step in that direction, but instead, 4 large companies high-fiving each other for investing in real estate to rent, knowing that they're cashing in down the road. The American dream of homeownership is alive and well, only not with American citizens, just with the large American companies who'll be renting out said homes to all those citizens. And just to prove my point, it took millennials quite a bit longer than the previous generations to hit the mark of 50% of them being homeowners. And the way they measure this is by looking at the percentage of each generation that were homeowners by the age of 30. And in that metric, just 42% of millennials at age 30 were homeowners, compared to 48% of Gen Z and 51% of baby boomers when they were the same age, according to data compiled by Apartment List. So the numbers are shifting pretty heavily in the wrong direction. This isn't a trend that changes dramatically overnight. It's a slow drip, but more and more it is creeping in that less and less Americans are able to afford being a homeowner, and more companies are picking up the slack. So I'm just here to say it again, buy real estate because they aren't making any more. In fact, all the big money players are making homes that you can't buy. So get what's available while you can. And just to illustrate the importance of this, let's chat a little bit about renting versus buying. So the question becomes, right now, is it ultimately cheaper to rent, or is it ultimately cheaper to buy? Well, if you just look at the costs on a monthly basis that you pay to live, being what you would pay in rent versus what you would pay for a mortgage, the answer is yes. Right now, it's cheaper to rent than it is to buy. Plain and simple. So right here in North Texas, for example, for a 2-bedroom apartment, it costs about $1,900 a month to rent. But for a 3-bedroom single family home, that number's closer to $2,500. However, if you get a mortgage right now on an average price home in North Texas, which is about $378,000, your mortgage with taxes, insurance, and mortgage insurance, because not everybody has 20% to put down, with an interest rate of say 7%, well, that mortgage payment is going to be about $3,400 a month. And by the way, I'm estimating taxes and insurance in realistic ranges. There's a lot of online mortgage calculators out there that way underestimate insurance and often underestimate taxes as well. So be careful when you're using those online calculators to figure out these payment numbers, especially with insurance being sky high right now, which I'm sure many of you are feeling. So let's assume that we're factoring out living in an apartment, which for most people, especially with families, don't want to do if they don't have to. And we're just going to focus on renting a single family home versus buying one. So we're looking at a difference of close to $1,000 a month. It's about $900, but there's a lot of variables here. So let's round up and say that it's about $1,000 a month cheaper on a monthly basis to rent versus buy. $2,500 to rent, $3,500 to buy. Argument settled. Yes? Well, not exactly, because although right now at this moment in time, it is cheaper, when you scale it out over 10 years, things get a lot more interesting. Let's start with rent. So from April of 2023 to April of 2024, single family rents increased by 5% on average across the country and in North Texas. This is according to Zillow. Now, you will see places where rent increases are less, but remember, that number often includes apartments, which a lot of new apartments are being built right now and coming online. And rents for those are expected to decline a little bit until the supply eases up. But single family homes are not in that same category. And for this example, again, we're talking about single family homes in a desired North Texas area where many people are moving to. So with a 5% increase in rent over the next 10 years, where does that put your rent? Well, it puts it at close to $4,000 for a 3-bedroom house in 2034, if that trend continues. Oh, and by the way, you have no equity, no ownership, and you probably had to move a couple times because of landlords, home sales, schools, etc. But I'm being very generous today, and let's say that your rent only goes up to $3,500. All right, let's check back in on the mortgage. So the payment that you took out today is $3,500 at a 7% interest rate. But since I'm being nice here, let's say that your rate never changed. You never refinanced, but your taxes went up and your insurance went up. And in 10 years or so, your mortgage payment's closer to $4,000. So in 10 years, your rent is still about $500 a month cheaper than owning. If, of course, rates never come down and you never refinance. But what about the home itself? Well, during the worst real estate sales growth in 30 years, from 2023 to 2024, we saw home values increase by about 5% nationwide. So that house you paid $378,000 for today is now worth about $675,000 in 10 years at a 5% appreciation rate. But again, let's be generous and say that the appreciation was only 4%. It'd be worth about $570,000. So in 10 years, if you never refinance to a lower rate, which most likely you will have, but either way, your loan amount would be about $304,000 and your home would be worth about $570,000. That's over $266,000 in equity you now have in that house because you owned it and didn't rent. That's $26,000 a year that you're losing because right now it's cheaper to rent than it is to buy. Now, again, to be fair, there are things like cost to buy and sell, repairs and maintenance, and the cash flow difference from what you were paying in rent versus what you were paying on your mortgage. But let's say all that cost and cash flow reduction got you to about $200,000 net gain from buying after 10 years. That's still $200,000 you got by just owning your home. That's long-term for short-term thinking. And remember, I'm being very conservative on these numbers and saying that at no point did you refinance your loan to say 5% in 2 to 3 years, which is very possible. And oh, by the way, that net gain gets even way higher at that point, almost 30% more. Now, I harp on this each week on the show about the threats coming in to buy up real estate and make it harder for the average consumer to buy. But I do that because I know the value of owning a home and how, given enough time, it can be one of the best investments that a single American can make. Because there's a reason that all the big corporations and big money are fighting over who's going to have the supremacy in the real estate market. They understand the value and the stability of the largest asset that most people will ever own. And I know it can be a stretch to make it work financially when times are tough. And it isn't an easy ask for many people. But if you do not own your home, but really want to, or you have clients that are on the fence, share this information with them. It could be the key to their financial. Well, guys, that's all for today. Rates are starting to ease. Inventory is growing. But if rates fall much more, you'll see much more buying activity. And that could lead to higher prices. Large companies are buying and building homes at ever increasing numbers. So if you have clients who are thinking about buying anytime soon, now is as good a time as any. And oh, by the way, there are a lot of programs out there that can help with cash. There's not a ton to help with rates, but rates will get better. It may be a few years, but they will improve. But as I showed you, home prices keep going up at a slower pace than they have, thank goodness, but going up nonetheless. So show your clients the math and help them understand short-term pain or long-term gain. And if you need help, give me a call and I can walk you through it too. I'm happy to help you or your clients in any way that I can. Also, join me live on Thursday as I welcome Chris Heller to the podcast. Chris is the president of OJO, an Austin-based tech company helping buyers and sellers navigate the complex real estate landscape, helping connect them to realtors and vendors in all other aspects of their home buying journey. And he's going to be here to tell us all about it. So tune in and find out what OJO is all about. Until then, be good humans and keep grinding. 'Cause life is what you make it. So make it great. See you next time.